Emirates, the biggest international airline on Earth. In 2008, it almost died. $1.5 billion in losses, 20 planes parked. Dubai was $80 billion in debt. This is how they survived. In July 2008, the global economy ran on record-high fuel. Brent crude surged to an all-time high of $147 per barrel, pouring billions of dollars into the Persian Gulf. 5 months later, the engine seized. By December, oil prices collapsed over 70% to just $32 per barrel. This massive drop instantly drained the regional cash reserves that had funded Dubai's aggressive expansion. The real damage came from the sudden shutdown of easy credit. When Lehman Brothers collapsed, it triggered a global credit freeze that stopped the movement of capital. Dubai's entire growth model relied on a continuous cycle of short-term debt rollovers. The city was built on borrowed money, needing constant refinancing to keep its massive projects alive. With international banks suddenly retreating to survive, that refinancing pipeline vanished. The consequences hit home in early 2009. Dubai's real estate market imploded, with property values falling 40% in the first 3 months of the year. This property crash threatened the state's ability to backstop its own commercial entities. Because Dubai lacked the vast oil reserves of its neighbors, it relied on its reputation as a global hub to secure credit. In this highly leveraged system, the state and its commercial flagships were tied to the same balance sheet. As property value was plummeted and sovereign credit lines dried up, the financial contagion moved rapidly through the state's portfolio. The sovereign-backed guarantee, which was the foundation of every major local enterprise, was suddenly called into question. A crisis that began in the international money markets had landed directly on Dubai's doorstep, threatening to pull down the flagship symbol of its global ambition. For Emirates, the global credit freeze hit the balance sheet with immediate, devastating force. In the second half of fiscal year 2008, the airline's reputation of absolute invulnerability vanished. The fuel bill in the first half of the year had already spiked by $1 billion, causing net profits to plunge 88% to just $77 million. Cargo growth offered a slight buffer, but it was nowhere near enough to stop the bleeding. The true crisis unfolded on the tarmac. Reports from the period indicated 20 massive Airbus A380 aircraft were parked, silent, and grounded. This ground-level reality was a severe operational wound. A single idle Super Jumbo drained roughly $1 million every month in lease maintenance, insurance, and crew costs. With 20 giants sitting inactive, the airline was burning $20 million a month to maintain static metal on the tarmac. Inside the executive suite, President Tim Clark faced the grim reality of this cash drain. Clark openly described this as the most painful chapter of the crisis, watching the airline burn through cash reserves to maintain assets that could not fly. While the carrier was built to absorb temporary turbulence, it could not survive a prolonged liquidity freeze. The operational machinery was grinding to a halt, raising a stark question for the leadership. In a world where global credit was completely frozen, who was left to save them? Dubai was carrying $80 billion in government-related debt. This was a structural maturity wall. Of this massive debt load, $60 billion belonged to a single state conglomerate, Dubai World, which managed the city's ports and real estate. As 2009 began, $11 billion of these total liabilities were maturing, requiring immediate refinancing in a market where credit had ceased to exist. The problem extended far beyond operational cash flow. In November 2009, credit rating agencies Standard & Poor's and Moody's downgraded multiple Dubai-linked corporations, including utilities and free zone operators. pushing key state-backed entities toward junk status. Lenders realized that the sovereign guarantor itself was struggling to meet its commitments. These downgrades restricted the airline's financial options. Emirates relied on the state's credit profile to secure international aircraft leasing facilities, negotiate fuel hedge contracts, and maintain short-term trade finance. When the sovereign backstop weakened, global banks froze access to capital. The cost of borrowing spiked to prohibitive levels, and foreign creditors refused to roll over existing loans. A routine commercial restructuring was impossible. The financial ties linking the airline, real estate developers, and the sovereign treasury were bound to the same ledger. Every major enterprise relied on a single, over-leveraged state balance sheet. The market could no longer price the risk, and outside capital vanished. The crisis had moved past the balance sheets of individual companies, creating a systemic emergency that required a political solution rather than a market one. On December 14, 2009, the terminal decline of the Emirates financial system was halted by a single, massive intervention. Abu Dhabi announced a $10 billion emergency cash injection directly into the Dubai Financial Support Fund. $4.1 billion of this capital was immediately deployed to settle a maturing Islamic bond issued by real estate developer Nakheel, averting a default scheduled for that very day. The remaining $5.9 billion was designated to support Dubai World's operations through April 2010, preventing a cascading liquidation across the state's commercial portfolio. This rescue was not a standard commercial loan. It was a politically charged, low-visibility transaction negotiated at the highest levels of the Federation. Khaldoon Al-Mubarak, the head of Abu Dhabi's sovereign wealth fund, Mubadala, operated as the central coordinator of the rescue channel. The deal carried no public disclosure of collateral or performance milestones, structured entirely as a political gesture to preserve the financial credibility of the United Arab Emirates. The capital transfer did more than cover Dubai's real estate losses. It stabilized global investor confidence in the nation's banking system, shielding sovereign-linked entities from further credit downgrades. For Emirates, this state-level stabilization restored access to the short-term trade finance and aircraft leasing facilities that had frozen during the panic. But the rescue did not signal a retreat, even as the sovereign ledger was being rebuilt with Abu Dhabi's capital. Dubai was already committing billions to its most expensive infrastructure project. Construction on Terminal 3 began in November 2004, a massive $4.5 billion investment designed specifically for Emirates and its expanding fleet. When the terminal finally opened on October 14, 2008, the global aviation industry was contracting. Yet Dubai was introducing a mega hub built to handle 60 million passengers annually. To outside observers, opening this colossal facility during a severe credit freeze looked like reckless overexpansion. But for Chairman Sheikh Ahmed bin Zayed Al Maktoum, retreating was never an option. Sheikh Ahmed justified the scale as a strategic necessity, arguing that without this massive capacity boost, the airline could never achieve the network dominance required to survive. It was a high-stakes gamble: build the infrastructure for tomorrow's traffic, or watch the airline's future suffocate under the weight of its own ambition. In fiscal year from 2023 to 2024, the airline's gamble on scale yielded a record 121.2 billion dirhams in revenue, approximately 33 billion dirhams. This represented a 15% increase from the previous year, driven by 62 million passengers. The carrier now deploys a fleet of 260 wide-body aircraft to dominate international transit lanes, sustained by the very megastructure and state-backed security that once threatened to collapse it. By refusing to downsize during the credit freeze, the government turned a regional rescue into an engine of global market share. The airline that once sat on the precipice of a systemic cash freeze now operates as a $33 billion sovereign empire. Subscribe to the channel for more inside business stories. Today, Emirates dominates global aviation, yet its survival remains tethered to the volatile architecture of sovereign debts. In our hyper-leveraged world, no empire is too big to fail. The line between global dominance and absolute collapse remains razor-thin.